Have you ever been scrolling through social media, maybe on a Friday night, and you see a financial influencer post the absolute perfect chart? They have drawn all these colorful lines, pointing to a guaranteed breakout. You think to yourself, this is it. This is the one. So on Monday morning, you take a chunk of your savings, you hit buy, and almost instantly, the stock reverses. You watch your hard-earned money just evaporate in front of your eyes. If this has happened to you, please take a deep breath. You are not alone. And more importantly, it is not your fault. Welcome. My name is Raj, and I have spent over 20 years in investment and wealth management. Today, we need to have a very honest conversation about something that is costing retail investors millions. The Securities and Exchange Board of India, or SEBI, recently released some heartbreaking data. 9 out of 10 retail traders lose money in the futures and options and short-term trading markets. 9 out of 10. But why? Well, it is because many of these guaranteed chart patterns you see online are acting as traps. Technical analysis itself is not a scam, but the way it is sold to you as a magic crystal ball absolutely is. Big institutional computers are specifically programmed to hunt you down based on these exact patterns. So today, let us break down 3 chart patterns that simply do not work the way you have been told. Let us start with pattern number 1, the famous golden cross. You will hear influencers scream about this all the time. A golden cross happens when a short-term moving average crosses above a long-term moving average. It is supposed to signal a massive new uptrend. It sounds amazing, right? Buy the cross and ride the wave to the bank. But here is the truth they are not telling you. Moving averages are lagging indicators. That means they are calculated using old data, prices from yesterday, last week, or last month. By the time that mathematical cross finally happens on your screen, the stock has usually been rallying for a long time. So, what happens next? The smart money, the big institutions who bought at the bottom, see that the golden cross has finally triggered. They know retail investors are about to rush in and buy. So, what do? They sell the shares to you, locking in their massive profits. The rally is over, the price drops, and you are left holding the bag. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs. A strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's continue now. Next, let us look at pattern number 2, the head and shoulders trap. If you have spent any time looking at charts, you know this one. It looks like 3 mountains. A small peak, a large peak, and another small peak. The line drawn underneath is called the neckline. The textbook rule says that when the price breaks below that neckline, you should immediately sell or short the stock because it is about to crash. But the market has evolved. The giant institutions know exactly where retail traders are placing their automatic sell orders. They know everyone is watching that same neckline. So, they do something incredibly frustrating. They intentionally push the price down just a little bit below that line. And once you panic sell, who do you think is quietly buying up all your cheap shares? The institutions. They soak up all that panic. And once your stop losses are triggered, they drive the price right back up. This is called a short squeeze. Finally, we arrive at pattern number 3, the cup and handle illusion. This one always makes me smile. It looks exactly like the side profile of a teacup. The theory is that after the handle forms, the stock will shoot up into the sky. Let me be completely honest with you. Without understanding the underlying fundamentals of the actual business, drawing a teacup on a chart is just astrology for men. A stock does not go up because the chart looks like a household item. A stock goes up because the company is growing its profits, because it has great management, and because it holds a strong position in the real-world economy. If you are buying pieces of a business simply because the line on your screen made a pretty shape, you are not investing. You are gambling against supercomputers that are designed to take your money. And as the SEBI data proved, 90% of the time, the computers win. So, how do we fix this? We have to change the way we look at the stock market. We have to shift our mindset from frantic short-term trading to long-term wealth building. Trading is a zero-sum game. But investing? True investing is partnering with high-quality businesses. I want to leave you with a simple assignment for this weekend. I want you to open your brokerage account and look at the last 5 trades you made. Just the last 5. Be brutally honest with yourself. Did you buy those shares because you thoroughly understood the value of the business? If you realize that you have been gambling rather than investing, do not be discouraged. It is never too late to change your strategy. That is exactly what we do. At EPK Capital, we build wealth for generations. We focus on real businesses, deep research, and long-term strategies that protect and grow your family's future. If you are ready to step off the emotional roller coaster of short-term trading and start building a real legacy, reach out to us. Thank you so much for watching. Stay safe out there and invest wisely.